Welcome to Trend Talks. In the latest edition of Trend Talks, we again have Dharmesh with us to give us insights on what's happening in the markets and what should be our thought process going forward. So, Dharmesh, welcome once more to Trend Talks. Always a pleasure to have you. While we have discussions offhand, this one is for the people who take keen interest in listening to you and understanding what's happening. So, starting off, markets all-time high, portfolios not moving at all. What's your view on that?
Thank you, Sridhar, for inviting me for the talk. Yeah, I do agree that markets are trending at all-time high, but portfolios are not feeling the same. In fact, portfolios are feeling that we are in a bear market, 10 to 15% kind of a correction on an average in most of the portfolios. And the reason, Sridhar, has been the earnings growth trajectory. If you look at the earnings, they have not been that robust. It's 5-6% kind of earnings growth on a broad basis. And if you, exclude the outliers and one-offs which has happened in few of the companies, so it comes a far bit lower. So in market, around 30% of the market is dictated by the financial space, 8-9% from the NBFC. So there the earnings growth trajectory was 4.5 to 5% on an aggregate basis. So that was dismal. Though the internals were quite encouraging on the earnings part, but when it came to profitability, because of few of the riders not performing well, the net profit was around 4.5 to 5%. IT, which used to be 20% of the basket, has come down to 10-11% of the basket. And this degrowth in the IT is again because of the aggregate earnings. So earlier when 20% we used to say the contribution to the total earnings was 20%. Now it is down to 11%. Though in absolute terms, they have been moving at 5-6% kind of a growth trajectory, but others have outlived IT. So another 10% of the market, you are seeing 3 to 4% kind of earnings growth. With a lack of visibility going forward, the managements are not very clear whether they would be able to go to double-digit kind of a growth trajectory again or not. And US remains a gray area. I mean, it's a very undecided area. AI is another area where they say now they are now moving to the implementation stage of AI from the developmental stage, but that the proof of the pudding is yet to come through. So 40% more or less of the market has not seen any earnings growth on the out of the balance. Few have done well, so markets have rewarded them. I mean, for in large cap space, I can take the name of Reliance Industries. They came out with a very stable set of earnings growth with retail segment doing well. So it is now nearing its all-time high level. Same was the case with Larsen & Toubro, the infra space. So large part of the infrastructure spend which government does has been done by L&T. So again, it is moving to an all-time high and taking the index away. So it's a very narrow market where few companies have done well. They have been rewarded by the market. But broadly, largely, it's a very anemic kind of earnings growth, 5-7%, and so has been the story with stocks. The other part is why we are seeing a drawdown on the stock prices. The reason being earlier to, 1 year back, last year September, these all companies were trading at very high PE multiples, valuation multiples, expecting the earnings growth to be around double digit or early 20s kind of a growth, which has faltered. And because of that faltering, the price correction has taken place to be in line with your earnings visibility. And that is what the adjustment is happening in the market. Second factor, which is a very significant factor, is FIIs have been on a sellout India. If you look at dollar terms here till date, as of today, we are down 3.9%. MSCI India I'm talking about, whereas other countries like South Korea, Taiwan, China have done fairly well. They have a different story to play out with. But as far as India is concerned, because of this earnings growth, degrowth kind of a trajectory, FIIs have been seller, point number one. Point number two is they are, because of US tariff related issue, which will play out big time in FY26, calendar year 26 first half. So that is yet to play out. They are sensing that there will be concern in MSME, small scale industries, and that will lead to degrowth in most of the large cap players, and that's the reason they want to be safe rather than being sorry. And tariff is still being negotiated. It's not being negotiated. We are, in fact, in the world, a meaningful economy who is paying the highest tariff. 50% is the effective rate of tariff, where others are far below it. Even China is around 37%, far below. And Japan and Korea US President has rolled back the tariff to 15%, giving them advantage. Third factor, because of FII pullout and all, is the currency depreciation. So that again makes foreign investors, the attractiveness of the Indian market goes down to the extent of currency depreciation is happening. So even if the return is 10%, 5% currency depreciates, so their net return is only 5%, and then the taxes all are applicable. So these are the factors which is playing out. I will sum it up. I think we are on the last leg of this play out of factors. Things should stabilize first, and then we should be looking forward.
Right, so the takeaway that I take from there is that the muted earnings growth is what is basically bringing the market to play in a very narrow range compared to the broad base that all of us would want to, because that's good for their portfolios.
Yeah.
US, like you said, will continue to be a question mark till the time there is an answer on the tariffs. Hopefully, we will find something happening. There is a meeting happening in the
Absolutely.
next 3 days. Currency depreciation, RBI, while it is intervening, I don't think that's going to happen too fast. You are a better person to judge that. However, in terms of markets, Indian markets, we have virtually not grown at all if you compare it to the global peers. Yeah, so where do you see our Indian markets going forward? You quite obviously said that FY26 could be the watershed year post the tariff results come out. But how do you see that playing out?
Yeah, I mean, a very interesting question to answer this. So, Sridhar, I will first, guide you on the macro things, how things have happened. And macro events take time to play out. It's not that instant, it's not an instant food kind of a thing. So, direct tax cut came in the month of January last year. Effects started happening from April month. Then you have indirect tax cut also playing out into the market. We have interest rate cut of almost 120 basis point till now, with RBI governor hinting that if the inflation remains benign, they would be going forward with a further rate cut in maybe on Feb. We can get another 25 basis point post the budget is rolled out. So tailwinds are there on the. We are net importers of crude and a large importer of crude. Crude prices have not moved up, though currency depreciation is neutralizing that. So these macro factors are likely to play out in favor of the consumption going forward into calendar year 26. So that is what the general expectation is. Per capita income will rise, consumer surplus has gone up. We have seen the proof of this in the travel and tourism industry, where the things have started picking up big time. So spending is happening. However, it's not, a very vigorous kind of a spending which has happened. What India is facing a trouble as of now is because of the import space. So imports have not reduced to that extent, which they would have liked to, and exports have taken a hit because of your US thing. So we are finding out new markets. It will again a transition. It started March last year. So it will take time for this to build up. I think in a 1 year time frame, there will be new geographies, particularly in the African side and the Middle East side, GCC countries, where India will find traction going forward. So those visibility, once the visibility comes into the picture, market will start, giving it a discount. So there the price traction should happen. So that's the broader thesis. On the currency, since you touched it, I would like to give a narrative, though it's not, apple to apple comparison, but go back to the year 2013. So in the year 2013, from the month of April till August 13, currency depreciation, Indian INR has depreciated big time, around 28% kind of a currency depreciation has happened, from 48 to 69 it went by. Same period, Nifty index corrected 14%. And then thankfully, Mr. Raghu Ram Rajan took charge in the month of August 2013. And next 1 year, the currency appreciated by around 14%. It was back to from 69 to 58 levels. And it was pre the Lok Sabha election. Mr. Modi has not come to the power. Indian market has appreciated 48% Nifty index in that period because of currency appreciation. So this year, from the lows of this year, around 83 was a low, we are now 90. So 9-10% kind of a currency, again, depreciation has happened in a very swift pace. And however, the index has not corrected because of few large cap companies which are domestic centric have been doing pretty well. They have been holding up. And IT gets a tailwind of this currency depreciation. So we have seen some rally in the IT index. However, stocks have corrected big time. So my expectation is, one is this currency depreciation, why RBI has allowed. Again, this is just a thought process. Maybe to counter the tariffs increases which the US has levied to some extent, some leeway you get there by currency getting depreciated. But what can play out this time in favor of currency, our currency getting appreciation maybe 3-4% next year, once the tariff deal is done. So then you can have a double barrel shot playing out. The domestic tailwind of macro policies and US tariff getting negotiated, leading to a currency getting stable and in an appreciative mode. And then we can have this a big rally coming into the Indian market.
Yeah, that's a good point. Just to take you back to what you said earlier, is this FII outflows that we have been witnessing quite regularly. At some point in time, they need to come back. Because once, like you said, if there is a stability in the currency and there is some kind of appreciation that does happen in the future, this money will find its way back to India. So I don't know whether it will happen the next year or the year after that. Till that time, we'll need to keep sustaining with the outflows. Thankfully, the domestic investors keep pumping money, and that's, to me, what's keeping the markets going. Otherwise, in the past, when we've seen FIIs go out, we've seen the markets tanking. When you see that money coming back, do you think we are in for a big rally?
Yeah, definitely. I mean, Sridhar, index has gone back to the all-time highs. We have made a new high, right?
Yeah.
And this is on the backdrop of 1.5 lakh crores of FIIs selling. So whether DIIs are buying, I mean, the mutual funds are buying or HNIs are buying, even mutual fund money is retail investor money. It's just the domestic money who has, taken this market to this kind of a high. So flows are important. I am seeing a situation where, this entire DI money keeps on compounding the way it is compounding, and then there is no negative selling from the FIs. In that scenario, you can get a real bump up into the market. But this will happen only when you have a clear visibility or earnings returning back to around 15-16% kind of a growth trajectory. So the street is divided. There are few pockets which say 12 to 13%, and there are few pockets who are already, I mean, these are big houses who have started building in 18% kind of a growth for FY27. My own sense is we will do more than 15% in FY27. So even if 15% is there, then I mean, FIs have no choice but to come back. And in between, if this tariff thing settles down, so you will have currency stabilizing, and this is the best time. It will be, I mean, in hindsight, we will come to know about it. But these 90-91 levels would be the best time for, FIs to come into the market if you are expecting 3-4% kind of a currency tailwind into their portfolio valuation.
So from that perspective, FY27 does look to be a good time for the markets, and it will make a lot of sense for people to stay invested now. What sectors would you recommend in the current situation?
Yeah, definitely. I mean, FY27 would definitely be exciting. So normally there is a saying, when there's a blood on the street, you should be greedier and hungrier. So this is the time when you should be greedier and hungrier. And the best part of this market is macro level, or nothing is wrong. There's no headline thing which is suggesting a caution. All headline, I mean, are suggesting that you should be aggressive into the market, and you are getting a valuation correction which normally doesn't happen in a roaring market. So this is a very ideal opportunity for investors. It may take 2-3 months kind of a pain. You may have still a drawdown of price of say 10-15% from this levels you are buying, in spite of the prices being down 25-30%. But that is how the market plays out. But the upside can be even doubler in next 1.5 year, 2 year time frame. So this is how the broader thesis is. Sectors, I would think the best sectors to take advantage of the current scenario, the way things are stacked, is one is the BFSI segment. Entire private banking space, public sector banking space, and the NBFC all are looking good. Even gold finances are looking pretty good at this time. The way the prices of gold and silver has rallied, and we think that these prices are likely to stay here or even appreciate further going forward. So trading, corrections may happen, but nothing meaningful or trend changing correction will happen there. So this is one space. The entire BFSI is looking very attractive, followed by defense. Defense is a long-term structural story into the making. If you look at the internals of any defense company, they are sitting at 5 to 6 times their sales order book is that great. Execution is speeding up. Government of India is ensuring that technology transfer happens in any deal they are negotiating with outside parties, and 64% of the content should be manufactured in India in next 2 to 3 years, which was 30% or 35% as of now.
Yeah.
So this will be margin accretive. That sector is looking pretty good to us. Metals will continue to do well, though it's for the braver. Some volatility will be there. That is another space which looks very attractive. Apart from that, specialty chemical, pharmaceutical should do pretty well. Infra and other spaces, you have to be selective. You have to be focused on the companies which you are selecting rather than getting a blanket stream. One statement which I would like to highlight here is the next leg of the bull market. I mean, from say 26,000 to 30,000, it won't be everything will be painted with the same brush. It will be the companies which are doing well, which are fundamentally sound, who are delivering earning, and there is a great business visibility. They are the ones who would be the winners. So you will have winners in every sector, rather than the sector being a winner. So it's a bottoms up approach kind of a market, which should follow in FY27.
Great. So, just to sum that up from my understanding is that you're gung-ho on BFSI, followed by defense, metals. Obviously, that leads me to my next question. When you say BFSI, while you spoke about NBFCs, PSU, and public sector banks, are you also looking at capital market players there?
Yeah, definitely, yes. Capital market themes will continue to grow. We have seen the growth in the capital market for last 10 years, over a decade, and this 14 crore unique demat account is likely to double to 28 crores. So the working population of India is around 60 crores. If you take double member family who are working, so 30 crores is should be a single unit, and 30 crores demat account is should be there, going by how the international standards are stacked. So that itself is an organic growth opportunity for the entire market. The infra plays in the capital market are the best beneficiary. I mean, the CDSL, NSDLs, and stock exchanges of the world. They you have annuity kind of income playing out. The AMCs will also continue to do very well, and valuation wise also AMCs get a better valuation than stockbrokers. So that area will be there. Coming to the broking part of the stockbrokers, there I think there's a lot of question marks as of now, because the regulator themselves are clamping on many activities which they think is not suitable for individual players as an speculator. So individuals can go good as investors, but as far as speculation is concerned, it's too complex a game, given the fact that most of algorithms have come into play. So to beat a machine, you need a machine. Humans cannot beat them. So if that comes into play, then there may be some volume degrowth, which to my mind is healthy for the markets. As long as you are buying into the cash segment, I mean, brokerage wise also it's accretive, and it's a more healthier and a more meaningful market than speculation. So speculation will get cut down. So those kind of a volume degrowth may hurt the stock brokers. So there we are not very bullish on. Apart from that, all other segments.
So you're talking about market intermediaries like CDSL, NSDL, maybe CAMS, Carvi, FinTech, K-FinTech,
Yes.
AMCs also could come into that space. Now the burning question, we've seen a huge rally in gold and silver. It's muting now. But what's the future for these metals?
Yeah, see, as far as gold is concerned, there are two reasons. One is all the sovereign central banks, they have been buying big time. And why they have been buying is because of the uncertainty in this resetting kind of a world, which Mr. Trump is trying to reset the world. So that flight to safety is the natural, course. And definitely these measures has disrupted the market. So dollar, though it's still the currency of the world, but there are a few question marks out there how long it can continue to be. So because most of the countries in this new world are trying to negotiate bilateral terms. So like India is doing with Russia or Iran. So these terms for dollar may get negotiated. And I mean, we all consume oil. It's been produced by all Gulf countries, but why it is sold in dollars? It's a basic question to be answered.
Right.
So these things will keep the gold up. Mr. Trump is the factor for gold. Silver is a different story. Silver, one is because of its bullion nature. The other is the industrial use. So 15% of the silver consumption is for industrial use. And all renewable energy coming into the play, any solar panel, you need silver wiring because it is better conductor than copper and lighter material. So 106 is the efficiency of silver conduction. In EVs, you have silver. So silver is industrial use. I think silver will continue to do well, but metals and commodity as a cycle, they operate in cycles.
Correct.
So after this upswing, I don't see 30% kind of a drawdown. 10-15% can happen any day, but then again it will consolidate and move up.
Great. Dharmesh, one question that will be in a lot of our investors' mind is that a lot of our investors have invested for the past 1 year and virtually not seen any returns
Yes.
coming up at all, right? Stock picking has been good, but the stocks have not played out. What would be your suggestion to these people? What should their horizon be? Should they be sticking on to what they're doing, or there should be a change in strategy?
No, Sridhar, there should not be change in strategy. 1 year has been lost for most of the investors, in spite of companies doing well. Numbers were also good. I mean, there are many companies which have given 25-30% kind of a CAGR over the quarterly earnings. Still, the stock prices are down. So, because there are many technical reasons where why the stock prices may be down. They may be selling by few funds. FIIs exiting and retail buyers not buying that particular kind of company which you have bought into your portfolio. So because of this, liquidity concern and not great participation in the mid and small cap space, there has been a burn on the portfolios and pain in the portfolio. So 1 year has already been lost. The best way to negotiate this is stay invested. If you still think your story is intact, the conviction is there in the company which you have picked up, the fundamentals are there, you may even top it up. That is the best. SIP, if you are doing outside, why don't you do into the companies which you know is going to deliver?
Right.
So I will give you one example out here. So 15 months back, we have, initiated Bank of India as a company in our large cap model portfolio. Then also we came out with the initiating coverage. It oscillated between 115 to 102 for almost 8-9 months. But its earning kept on compounding at 25% or so net profit for the last 4 quarters, with credit growth of 12 to 14%, with asset quality improving. Eventually, the stock price traction came, and recently it went to 148, 149 kind of a level. So this is how your conviction plays out. Patience is the only answer for good investment.
So I think that's the best byline that you've given today. Patience will be rewarded, and people need to stay put and top up wherever they find opportunities. People have seen a great upside till the September of last year. People thought that they were making a lot of money. Investments came in. Last 1 year has been muted, but the suggestion that should be going to all customers is to stay invested and be patient, and the markets will reward you.
Definitely, yes.
Yeah. Thanks, Dharmesh. As always, pleasure talking to you. Thank you.
Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.